Okay, welcome everybody to Private Equity CXO's latest webinar. In this session, we're going to be covering how management can try to best navigate the nuances of private equity governance and have a productive, effective relationship with their sponsor partners over the 3, 4, 5 or more years that they're together, and ideally get to that great liquidity event that has us all doing what we do for a living. So we're here on Private Equity CXO today. And as many of you know, this is the world's largest digital community of private equity-backed executives, where our mission is to try to inform, support, and connect leaders in this space to try to ensure a healthy asset class for years to come by cultivating the talent side of the portfolio company leadership equation. My name is Rob Huxtable. I'm a partner with Falcon, which is a retained executive search firm that focuses exclusively on the private equity-backed mid-market, where we conduct operating partner, CEO, CFO, and head of commercial searches. And before I introduce my panel, some quick housekeeping for all of our guests in attendance. Thank you for being here. There is a Q&A portal where you can submit your questions, and we're definitely going to prioritize getting to a number of those throughout the session. So please don't be shy. And super excited about our panel today. Between our three panelists, we've got more than 15 tenures of C-suite leadership in middle market companies. We've got CEO covered and we've got CFO covered. And a lot of experience and perspective on multiple sponsor engagements, multiple hold periods, and collectively, these folks have nearly seen it all. So let me welcome first Bob Craycraft, who's a multi-time CEO of multiple private equity-backed companies. He's on his 4th tenure as we speak. Experiences included multi-site business services, as well as tech services, product companies, and distribution. So Bob, welcome. Really glad to have you.
Great. Thanks, Rob. Looking forward to the session today.
Okay, great. Next, Heather Zorge. Heather is I believe, 6-time CFO, so she's a masochist. That's for sure. Heather's been with multiple sponsors, all middle market focused, and has been involved with a number of successful transactions. And today she is in a veterinary services business backed by a private equity firm and first time institutional capital. So she is busy building a platform that's going to do great things. So Heather, really glad to have you here, especially from a CFO perspective.
Thank you, Rob. Super excited to be here. Thanks for asking.
Great. And last but not least, batting cleanup, Keith Buckley. Keith, I believe it's a 6-time CEO tenure. So what a great track record and a lot of different perspectives. And Keith comes earlier career kind of product and IoT type businesses, and here more recently in the last number of roles, more technology focused, software as a service and the like, and also experienced and been there, done that with a number of sponsors and a number of successful exits. So Keith, welcome to you as well.
Thank you very much. Appreciate the opportunity.
Okay, great. So purposes of today's discussion, when we were doing our prep session, we sort of agreed with each other that we ought to define governance. For purposes of today, it's really just the whole behavior set of how management can best engage with sponsors, endure and navigate sponsors, advise and influence sponsors, and do their part to help create a highly constructive relationship. And, it's not to put it on the private equity side, because those are our wonderful clients, but certainly management can go a long way toward making that relationship more or less effective. And that's definitely what we want to talk about here today. So before we kind of get into specific questions, Bob, if you could just get us started with maybe some general thoughts on governance and what you've seen with your 4 different sponsors, and what people can be sort of thinking about as they evaluate their next opportunity.
Yeah, absolutely. And, I think to your point, I've been kind of the full spectrum of PE firms, from distressed debt, private equity, all the way up to TPG. So from the crazy of the crazy to the big of the big, and they're all kind of crazy. But, I think as you get into any opportunity, I think probably the first thing to understand is, the ability to set expectations. And I think people take for granted, private equity guys are in a lot of deals. They see a lot of deals. They understand the math really well, but, they really look for you as the C-suite to really kind of set the agenda, set the stage, set the expectations. And so I think the better job you do of coming in with a kind of a platform and game plan and help frame up how you're going to go through this, transition, if you will, because every deal is about you're starting from a spot, trying to get to this spot. And the better job you do of laying out those stepping stones about how you're going to get from here to there, and that you're in control of that, and that as you say, okay, hey, from this time frame, we're going from A to B, and here's the signpost that'll tell us that we're doing a good job of that. I think if you go in knowing that you're in control of that and can set those initial expectations, to me, that's always been one of the keys. And when I was a first-time CEO, I didn't really understand that. So some of those expectations got set for me, but I learned that over the years around, man, that is so important, because if you're not on your game plan, you're on their game plan, and that's chaos, because they have the attention span of a gnat. So they're always flipping around. And I always tell this to people, they retain about 10% of every meeting. So, as you're going through things, the more structured you can be, the better the roadmap that everybody can, and they see that consistently, the better retention you get, and the more, I say buy-in, and the less chaos gets created.
Yeah, certainly that's what we've seen from our ringside seat, that someone's setting the agenda. Management has an opportunity to try to do that. And if they don't, private equity sure will. And I think what I've seen is that even the more prescriptive sponsors, deep down inside, they want management to have a playbook and to sort of drive the agenda and allow them to be value add and sort of play that second fiddle role. But if management doesn't occupy that space, they're going to be all over it, and they're going to fill that void for sure. So, Heather, how about from your point of view?
I think that what's helped me as I've navigated PE relationships is, one, being confident in my approach, sharing that approach and getting buy-in. But I also think it's understanding they will cue you into what is important to them. And so really navigating, giving them what's important to them while also balancing what your business needs. I think sometimes what can happen, and what I've seen and done myself and had to learn from, is they will have an agenda, as they should, right? They've invested a lot of money, and you have to be respectful of that. But sometimes they won't understand how much maybe their agenda and their needs are pushing non-value add work into the business. So the sooner that you can come in, establish what the actual environment in the business is, because I do think that is missed often. A sponsor only has so much time and so much ability to understand the actual environment that the business is operating under. And you have to educate them to that, and you have to have the confidence to do that. Otherwise, they can, through, honestly, usually what I have found, not really intentionally, because, many times you're dealing with a lot of humans that are super smart, but maybe a lot of them haven't worked in a business every day. And so they're just giving you their best ideas, which are really interesting. So it's really a matter of assess your environment, be honest about that environment, be intentional in how you approach them. Hey, if I get you want these 10 things, 2 of them will help us in our strategy that we are all aligned on. The other 8, we're going to wait on. And here's my why. And often you will find that they will be okay with that. But if you don't have the confidence to push them and also use them for what they are really good at, which is, seeing the forest through the weeds and all those things, you can, really not leverage the relationship in the best way that you possibly could. So high level
Yep.
for me.
Yeah, we see a lot of analysis that lives in spreadsheets within private equity firms. And, I think management's job is to try to help sponsors contextualize that data for the realities of the business and the human beings and the markets involved. Not to say that private equity doesn't understand it, but when it works well, it's this nice confluence of perspectives, management, private equity, enriching each other's views.
Yes.
Versus one living under the other's shadow, so to speak. Keith, how about from your point of view, any high level thoughts?
I think that both Bob and Heather hit on some good points there. The one thing that's sort of underlying, and I would not, if any of my former or current sponsors are on this call, this really isn't about you when I say this, but nobody knows what they're getting into in a deal, right? No matter how good you are, you don't know. And to Heather's point about identifying things that there may be 10 things that the sponsor wants, but it's 2 or 3 of those are going to answer the question that I like to ask of our sponsors, which is of my sponsors, is how does what you just asked me help the business, right? And so getting down to that 2 or 3 that are actually going to help me do a better job of running the business, because they're good questions, but the other 7, which are also good questions, but they have no benefit to the business, how do you get those out of the way? And I think the other part of it too is that in that understanding of that a buyer or a sponsor in general does not know everything that they, good, bad, or otherwise, that they could know within the company that they've acquired, is also that balance of Bob, you had said at the beginning, first time maybe didn't do it the right way. Like first time come in as a CEO and tell your sponsor everything that's wrong that you've discovered in your first 30 days on the job, and then just sort of drop that mic right there and expect that something good's going to happen. It ain't. Right. So here's the 10 things, and certainly I've made that mistake. Here's the 10 things that I've identified that are majorly broken with the business. And here's exactly how we're going to fix them, or at least here's directionally how we're going to fix them. So let the sponsor know right up front that you've got it under control. Right. And so that's an important aspect, I think, of what we're talking about here.
Yep. Okay, good deal. And just a quick reminder to our 125 in attendance, by all means, submit your questions on the Q&A portal and we'll definitely get to those. So one of the terms that we see used by all private equity firms on their website, I think it's 100% compliance, is that, quote, we partner with management. And yet every sponsor, if you really look closely, has a radically different and unique definition of what that means. So maybe Heather, if you want to start us off, when you go into a new deal or you're interviewing, how are you trying to solve for, okay, what do they think partnering with management really means? And how can I try to influence that in a way that can work for me?
Yeah, it's really interesting. That is actually a question that I ask in my interview process. I have learned in my tenure that fit is so important for both them and for me. You don't want to enter into a business where you are not aligned culturally with both your CEO, your business in general, and your sponsor. And so it's funny, even my last one, the answer was actually very unique, and it was, I won't cuss on the call, but it was like, don't be a jerk. And I'm like, and I think they were so shocked. And I said, well, what does that look like to you? Tell me about, how do you define what showing up as a jerk is? And what was really interesting to me, and one thing I really, really enjoy my current sponsor group, and they said, well, we can't show up for you and be that way. which was actually not totally what I expected them to say. I thought it would be more about how we need, meaning management needs to show up, right? And they were very self-reflective. And so what I would honestly say is ask the very pointed questions. Don't let them give you the generic responses, which, oh, it means we're going to make decisions together, or, all those things. But really ask them, I ask, tell me about the last time you had a disagreement with one of your portfolio companies. How did you work through that? Tell me about the last time that you proposed an idea to one of your management teams that they felt wasn't good within the business, right? How did you respond to that? You have to ask very, contextual questions that don't allow a yes or no or a generic response. And then if they give you partnership, really ask them to define that in a behavioral way, and see what they come up with. And then you'll be able to dig from there. But I think it is probably the most important thing that you can do, which is make sure you're going to work really hard, right? That you're coming in, you're going to work hard over the next 3 to 5 years. You're going to accomplish a lot of things, which is what makes it fun. If you're doing that with a partner that just makes you crazy, that's not as much fun.
Yeah, well said. And that partnership means a lot of different things to a lot of different sponsors. And
It really does.
Some are not even really intentional about what it means. And we tend not to want to represent them when we do searches. But anyway, Bob or Keith, jump in, please.
Yeah, I think two things just to build on what Heather was saying is anytime as I've gone through this multiple times, I ask two kind of key questions for me. One is if they have an operating partner structure, and again, and I've seen it all the way from none to many, do they use a push or pull method on the operating partners, right? Because a lot of guys like to say, we have this great operating partner team and they're going to come in and help you. And that's where you need to go, whoa, hold on a second. Not that you can't use the help, but, if you can say, hey, we've got this initiative, this project, you've got a specialist in Lean Six Sigma. Hey, I would love business versus them pushing it, because those operating partners that get pushed onto the business, they're all going to they all will generate ideas. They will generate, incremental thinking, but, is it in the, joint strategy and operational improvement of the, both your leadership team and the board? And so understanding that push versus pull is very important. And then I always ask and say, hey, I'd like to interview 3 former CEOs. So I'd like to have at least one guy that's gone through an entire transaction with you and completed a transaction, and then 2 current guys or gals, whoever they may be. And, I do kind of the reverse reference check on them through former C-suite folks. And then I'll actually look in LinkedIn and other places and see if I can network with some folks, because people that have had the shared experiences can give you the real story behind that. And, I think, from what you have to do, the pressures that are on the C-suite every day, from the time you're in till the time you're out, it's just, and I had a very bad experience in my first go around with this. It's ego will let you think, hey, I can work with anybody. I'm smart. I'm hardworking. I can do all these things. And, sure, these guys they're tough guys. They have a tough reputation, but I can do it. Well, you're wrong. and I realized I was wrong before. So I think those are the 2 key things around evaluating that, around are they truly partners? And if you can get those 2 boxes checked, for me, I have found that that's played true, through my last couple of deals.
And Keith, if I could just prompt you more specifically as a final thought here, is there an example or 2 that comes to mind when, boy, that sponsor really did partner with us? I think this high level concept sounds good, but it is nice when it's put to the test during a moment of sort of duress or challenge when that partnership's been demonstrated. Anything come to mind that would be a good example?
Having done a couple of several like legitimate turnarounds, right? You do need a partner, and the definition of a partner is a partner, right? You maybe one is a little bit stronger on one thing and a little bit weaker on another. So you need that. You truly need a somebody who is going to act like a partner. And so when you look at for example, in a turnaround, there are times where economic conditions, financial conditions of the company, eyes wide open, distressed acquisition, whatever. I can't run the business if I'm also having to if I'm having to pay attention to every single penny that happens to be going out the door, or if I'm so worried about treasurer, I'm so worried about our covenants, et cetera. So there was one for sure where we were, again, eyes wide open, acquired as a very, very distressed company. And in that case, our sponsor did a fabulous job of managing our relationship with our bank and managing our relationship with our lenders to ensure that we had the bandwidth to continue to do what we needed to do without getting involved and telling me what to do on my job. They handled their part. I handled my part. We both made it all the way through, survived the worst parts and went on for an excellent exit. I would say the second one that comes through a good example is we had a situation where, again, a company that was in not great shape, but the best partners that I had, I think to date, probably pretty accurately would be the ones that literally just listened. It was, to Bob's point, it was much more of a pull. I'm having a challenge here. This is what I plan on doing on it. Any ideas related to it? And otherwise, they stayed as far away from me as they felt they could, because they knew that we had a heavy lift and they just didn't need to get in the way. And so both ended up with very good exits.
And that's just a quick editorial comment, getting a lot of feedback on interviews and people who've been in jobs. Not enough executives are being the catalysts in that regard. And I think there's a real opportunity for everybody on every management team to put that information at the forefront with their sponsors, lay out their issue, their intended game plan, and ask for input. What you don't want is them identifying the issue and asking you what you're going to do about it before you've had a chance to get out in front of it. So a couple great questions from the audience. Let's unpack a couple of these. So one is, has anyone ever used any kind of documentation, be it a memo of understanding or any other kind of sort of way to outline the roles and responsibilities that distinguish what the board is going to do versus what the CEO is going to do? I candidly, I've not seen that. It's been more informal, but curious what the panel has to say.
I'll go first. I have not done that. In hindsight, that would have been hysterical in a couple of our situations to have gone back and said, "Hey, remember what you told me you were going to do? Remember what you did do? Here it is on paper. Can we go back to the paper?" But no, I've never seen that in the past.
I have not seen that either. I've seen it on my public boards. It's much more formal and whatnot, but not in a PE environment. I think the thing that I have found that is useful to document is really agreement upon and alignment with strategy and priorities. And if you're doing that and everybody in the room understands this is what we're trying to accomplish, and this is the human in the business that's going to be doing that really, that's, I would say, from a documentation perspective, where we spend the most time. Nothing beyond that.
Yeah, and I think what we hear a lot of feedback on is prioritization as a whole, and that the sponsors where there's been a more productive experience on behalf of management have been able to prioritize and segment issues into red, yellow, green, or whatever, as opposed to everything's a fire drill and everything needs to be handled yesterday, and if not, there's going to be some trouble. So yeah, getting that lined up. So Bob, outside of an MOU or something formal, have you had any success trying to ensure where we're all going to swim, which lane we're going to live in, and how the board and the CEO can not get too cross?
Yeah, I mean, I think it goes back to Heather's point, which is, I think if you can get the clear objective lined out, and then get the strategies identified with the KPIs that go with those strategies, and then say, okay, hey, here's the next steps, or here's the initiatives that are going to be in place to help drive to this strategy. I think that as long as everybody can get viciously aligned, that's what we're doing, and that we've done the analysis, we've run all the data, we've done the back end work, whether it's, customer work, competitor work, market work, whatever we have to do to get line that, yes, this is the way we're going to, win the battle. To me, that's the thing. And you have to stay true to that, because I think Keith made this point, which is a great one, which is, you've only got so many calories. The executive team can only really drive one or two major initiatives a year. And then obviously there's always those small ones that get driven by individual contributors and maybe some small work teams. But when you're talking a big cross-functional change, it takes a lot of effort and energy. And so I think what that document allows you to do is to say, okay, man, we've all agreed to this. And if there's something that can produce better results faster, that we all agree upon, we're not deviating from, this page, right? We're not deviating from this prioritization. So, to me, that's always the cornerstone of the relationship with the board. And then I think the other piece that you have to get clear is how often are we going to communicate about it, and how are we going to communicate about it? Because, these guys can take you down rabbit holes and rabbit trails that, you've never even thought about before. But I think that, if you can always bring it back to there, that's so important. So I think that's the, one piece that, man, you've got to get committed to that. And then as the leadership team, stay committed to that, right? And because you can go into a board meeting and, the latest headline, right? Whether it's debt ceiling, recession, interest rates, war, you can pick any headline you want. Can all of a sudden the PE, those guys are always thinking, they see a lot of different things, and they're thinking, okay, do we have to, take a tack? You really have to be able to step back and say, for our hold period, what we want to get done, what we want to get accomplished, does any of that kind of knee-jerk reaction, help us? And usually the answer is no. So, make sure you can stay that knitting. But, the thing I always tell my teams is that we are the brand stewards. We're the only ones who are going to care about the brand. And whether you're in it for 1 year, 2 years, 20 years, we got to make sure that we protect our piece of history here and our legacy. And so we're always going to do the right thing for the long term of the brand. And that should be a good thing for the outcome of the transaction, for their shareholder transaction. So I think, knowing that you own that as the leadership team is so important, because once the transaction's over, these guys really, nobody cares about it, right? Once as a stockholder, I own individual stocks. Once I sell that stock, I don't care about it. It's the same thing here, and not that they should, but the operators of the business, you have a legacy to protect, right? And your time may be short in organizations, but you're writing those chapters of the history of the company while you're there. So, getting grounded in that playbook is so important.
Yeah, good deal. Thank you, Bob. So this next question is a little bit more sort of career focused and interview focused, but let me pivot it into a kind of a governance angle, if I could. So the question is about, when you're interviewing and you're going to be a first-time CXO of a portfolio company, and the sponsor's asking you for your assessment of the business and what are you going to do, to create value. So the tactical answer that we see is, you get on an NDA, you ask them for a SIM. If it's a newer deal, you ask them for a redacted board deck, you ask them for whatever you need to do to develop good insight. And then you want to put together a really thorough 90-day plan. that is explicit, but what I wanted to throw out to the group is, I think my counsel to candidates is always step back and quit trying to get the job with blinders on, and behave in a way that helps the board understand who you are, so that they can help decide if you're all going to be happy together. Because if you behave in idyllic candidate mode, you may be hired under false pretenses. So when you're doing these presentations as a final interview step, has anyone done anything to put the reality of who you are and the reality of what it's going to be like to work with you into those presentations, knowing that if the sponsor doesn't like it, you'd much rather them decline your candidacy than hire you under bad pretenses?
Yes, I have done that. And the first time I was asked to do something like this, it was quite intimidating. Right. I think as executives, especially CFOs, but most of us, right, we're data oriented and we want to know the things to make a decision. In this instance, you're given, a sim of 35 pages with information, and you're very, I think, intimidated by, am I going to find the thing they want me to find, or am I going to say the thing? What I found I did is I just decided to just do what I do. And present them with what I saw. And some of it, I would say it was, it was hard to kind of call their baby ugly a little bit in certain instances. And here's what I saw when I was looking at the data. Here's the things that I think we're going to need to focus on. Because what I'm very honest about, I am not a yes man CFO. I am going to give you my opinion. I am also going to listen to what we need to do. So if that's not what you're looking for, if you're not looking for someone that, if you're, at least specifically for the CFO role, a lot of the times I've found companies say they want a CFO, especially, those first ones. And I'll just be honest, it's not a CFO, it's like a controller basically, which is very different. So I think, what I decided is, I have to make sure that this sponsor and frankly, this CEO is actually looking for a partner in the business. And this is what partnership with me looks like. We're going to talk about the hard things. We're going to challenge all the great things that you think you thought you saw. And here's the reality of what at least from my perspective, what I'm seeing. And it actually, it didn't backfire, amazingly enough. I mean, I didn't take the job, but not because of that. So.
Yeah, I think the more we can pivot away from interviewing with each other and creating a mutual due diligence environment where there's total transparency. And if they don't like what you have to say, you wouldn't want to be there anyway. So don't be afraid to not get the job. Bob or Keith, any thoughts on this topic?
Go for it, Bob. I'll do cleanup again.
Yeah, I guess I'm kind of like Heather. I've been asked to do similar things, and actually the job I'm in right now, they asked me to put together a 100-day plan, present the plan, kind of, I had the sim, all those different components, but I had a pretty good knowledge of the industry coming in, but I just said, hey guys, here's what I'm going to do in the first 100 days. Whether it's talk to people, the employees, suppliers, customers, board, all those things, and gather all this information, as kind of I call it the listening tour, right? But at the end of the listening tour, here's what we're going to have. We're going to have a refresh vision, mission, and values. We're going to have a prioritized list of initiatives. We're going to have those, 4 or 5 strategies we think it's going to take to get us there. And then, we'll be working on as many of the KPIs that we'll have as a signpost along the way, right? So at the end of 100 days, this is what we're going to have. And, and here's what I'm going to work on, right? I'm going to work on our people, on the strategy. I'm going to work on motivation, and I'm going to work on knocking down hurdles for the business. And so if those things are part of the recipe that makes sense, then, hey, then, to Heather's point, I think maybe we're lined up. But if you just want somebody to come in here and cut cost or, do, some, what I call them very mechanical things that have to happen, then, hey, I'm probably not your guy. But, around, if you want to truly build a business, build a brand, build company culture, those type of things that get you to, create a lot of value. And those are the kind of things you get there, because, Keith made this point earlier, and it is so accurate, is, if you can look at a SIM and diagnose a company, God bless you. Because, every SIM is written to be as beautiful as possible. And that's like going on a crash diet and losing 30 pounds. And, 2 weeks later, you've gained 15 back. I mean, because the devil's in the details, and it's in those operational KPIs that really tell you a story that you don't know till you're on the inside. You can't know till you're on the inside, because you got to get down to those layers to figure that out. But I mean, I think that's I think for me, anything beyond that, you're kidding yourself. And I'll put this other word of caution out there, is that if you do make some assumptions and you're wrong, then man, you're digging yourself a really big hole out of the gates. So, I mean, until you can get in and really dig in, you really don't know. And so until you know that, you don't want to make any kind of proclamation that may or may not come back to bite you in the butt.
Yeah, exactly. Anyone who comes to me after looking at a bit of paperwork, or after even, talking to me a few times, interviewing for a job, if it's one of my direct reports, if it's me, I would say the same thing to somebody that is interviewing me. If you think that I can tell you how to fix this after this cursory look, then we're definitely in the wrong place. And to Bob's point, you're going to end up in a bad spot, right? I think that for me, when I'm asked to do case studies, and having been burned and done the free consulting, too many times, there's no other way to say it. It is, where I've spent weeks putting together some kind of a presentation, which then basically just goes into their database for them to use for the future. I don't like doing that. I'm not a big fan of those sorts of things. I'm much bigger fan of, show me what your investment thesis was. Let's talk about what you see as good, bad, and ugly in the company. Let's talk about how I would address those, knowing what I know today, but also knowing that I'm going to go spend some time. I'm going to spend the 100 days or the however long it takes to get to the answers that either prove or disprove your thesis, or where we can refine it. But I can identify those areas. We'll talk about how I would go about identifying the areas that need improvement, and the areas that need us to leverage for better performance. The things that are doing great. Well, how would I leverage those? I'd much rather have that conversation, because then there's going to be an alignment or not of how the sponsor and I are thinking. And so rather than coming in and saying, hey, I've got all the answers, and I'm going to solve this for you after solve this business for you after, reading 35 pages, that just doesn't make any sense.
Mm-hmm. Yeah. And I think,
Rob,
yeah, go ahead, Bob.
Let me just build on one thing Keith said there, because I think it's so important, is that every PE firm, as they go to their investment committee, has a list of 4 or 5 reasons to believe they should do this deal. And you need to ask for those reasons, right? And so, there's the investment thesis, but man, there's 4 or 5 things that they got committed to, that investment committee backed, the equity funding of these deals. And, you want to get down to those 4 or 5 things, so that when you're going through that first 100 days, to Keith's point, you're either validating, invalidating, or, changing it slightly, because you only have one chance to do that. So after you've got through your for onboarding, the honeymoon phase is over, if those things need to change or have changed, everybody needs to know that up front, because if not, those will circle back on you. So, I mean, I think what Keith said there is very important on that piece of it.
Yeah. And, part of my message to candidates everywhere is there are 12,000 or more PE-backed companies in the US. You don't need any one gig. So if you can't get squared away with that sponsor and you all aren't on the same page about what good looks like and expectations, it's okay to pass and wait for the next one. So anyway, let me blend a couple questions here into one theme. Heather, I'll tee you up if I can. So this is about, sort of either an overly zealous board member making ad hoc requests, which are non-value add, maybe work in the business, and or counsel that just feels off or incorrect from a board member, deal person. So you've talked about, you kind of push back a little bit by saying, do you understand what this means, this request means? Maybe my question for you is, how long of a journey is that to build that kind of credibility? I'm sure it's not a one and done, hey, this is not how I like to work, and you're asking me for non-value work. Just at a high level, what's the journey to credibility look like?
I think what I've found works is there's going to be a why for what is being asked for. Whether or not you agree with that why, or you think that why is sound, right? There is a why. So one, I think that if you sit with and understand the request, you really do your diligence on understanding the work that would need to go into that request by the business, by your team, in order to present that information to the sponsor. And then also see if you, as you understand, here's the why, here's the request, here's how long it's going to take for me to get that work done. How does it then fit into the strategy that we've agreed to? And that is where I have had by far the most effective conversations. At the end of the day, humans want to feel heard, and PEs are no different. And they want to feel like you understand your business, what you're doing, and why it is that you're say pushing back for, And so I have found that if I just immediately, like, I think we all know we have guts, right? You're like, oh my God, this is gonna be a stupid thing. It's not gonna help anyone. If you immediately give that feedback without building up a thoughtful response, and I think you will lose your audience. And I've definitely experienced that before when I've maybe made a gut decision given just priorities and busy. So I highly recommend, make them feel heard. There will be some tidbits in there that are good. And so I think you have to be open to that and seek out the things that do align with strategy, get those done, and then have that conversation with your, main operating partner on the other side saying, hey, here's what I'm seeing. I have found honestly that, like a specific example, I was in a business for maybe a month, and there was a 2-hour sales call, and it was all of our sales leaders sitting on the phone with the board, and the presentation took, 2 weeks, right? And the business is underperforming on revenue. They're not meeting targets. The check was the biggest check they'd ever written. Everybody's uncomfortable. I found, because I watched the process, I understood what was going into it. I was just listening at that point. And then I had a call with the sponsor. They had no idea that the sales leaders were not selling for 2 weeks because they're too busy preparing this information. And the other thing I pointed out to them, because I think sometimes, again, you have to have the confidence to point this out. If you're preparing a ton of information and your sponsor never responds and they never ask a question, that is a key indicator that it's not the right information. It's not driving action. Anytime you're on the phone, you're creating a presentation, a report, anything, and it doesn't drive legitimate discussion and action, it is non-value add, and we are wasting our time. And so if you can come forward with a thoughtful approach, here's specific examples, here's what we can use in the business that will align, you should get there. If you can't, and they won't hear you, I think there's a decision in your hand. Are you in the right position? Is this the right partnership for you? And I think that's hard, but longer term, it's going to be better for both parties because you're going to knock your head against a wall. They're going to be unhappy and it won't work. So, but just be thoughtful about it.
Yeah, I would agree with that. And the time to do that is while you still have a job, because you wait until you're terminated, you've got some impossible questions that have no answer, that are going to impede your job search. And then I think it's really on the executive to take their scrutiny from a 9 out of 10 to an 11 out of 10, because what you really don't want is back-to-back stints where there's no exit. This is all about exits. And you kind of have to have that governance fit to have a shot to get there. Hey, Keith, another question from the audience that lends itself to your experience of having done healthy growth businesses, but also turnarounds. If you had to boil down the main difference of sponsor behavior in a turnaround, losing money, trying to get back to break even context versus we're trying to take a good business and make it better, other than managing for cash and the nuances of scarcity, from a pure play governance standpoint, knowing that all sponsors are pretty intense and ambitious, what's the biggest distinction in your mind?
Gosh, that's a good one. You didn't stump me, but I got to give it a bit of thought here. The turnarounds that I've led have typically been, I like to say I'm not very good at the financial side. That's why Heather's here, right? My job isn't to figure out how to engineer a turnaround from a financial perspective. It's always how to engineer that turnaround from a growth perspective. So the difference between, so both companies are going to end up, because growth cures everything, both companies are going to end up with a similar strategy from me in terms of, where I'm going to focus my energies and to get us out. I think the way the sponsors have reacted tends to be who is, again, going back to that partnership discussion before, who's going to be the partner that's going to help me with the downside risk problem, and who's going to come in and say, let us take that part off of you so you can go execute on the growth perspective, versus when it's a pure growth play, then you have I want a partner who's going to say, okay, how can I add value to what you are doing to help grow this business? And since you've already, your balance sheet's in good shape, you guys are cash flowing, whatever it happens to be, right? And so if there's a difference, it's the good ones, it goes back to the subtlety of who's a good partner. We're going to identify what are the needs of the portfolio company, what are the needs of the executive team, and where can that partner provide the value.
Yeah, I think what I'm hearing you say is that if you squint your eyes, there's really no distinction about the relationship between management and sponsor in a turnaround versus, a healthy business. You still want alignment. You still got to focus on shared priorities, and mutual buy-in. Good deal. Hey, Bob, I don't know if you've seen this, and if not, feel free to pile on to Keith's answer, build off of it. But have you ever been in a situation where you were getting conflicting advice from people within the same sponsor group? So the MD or the partners telling you X, and then the principal or VPs telling you Y, or the operating partner or non-exec chair's got her or his 2 cents. If you have experienced that, what's the recommendation on how to rectify?
Yeah, and unfortunately, I've experienced this twice when I was going through it. But so the last time I had to go through it, and it was a unique situation because the lead partner we had 2 partners that were on our portfolio company. One was a lead, one was kind of riding shotgun. And then the managing director was, from afar, because it was a big bet for this fund, right? It was the biggest bet in the fund. And so what was happening was the lead director was trying to save face within the organization because it was underperforming at the time. And so the other guys I was getting definitely conflicting messages from the 2 guys that were on the board. Fortunately, I had an outside board member plus an outside chairman that I was able to lean on during that process and say, hey guys, here's what I'm hearing. Are you guys hearing the same, conflicting stories? I got aligned with the two of them, and then we were able to, come forward at a board meeting and say, guys, here's where we're at. And again, it was underperforming at the time. We had to make some tough choices. We were in upstream oil and gas, and when crude went down to $16, it was very painful. But we were able to say, here's the assessment of the situation, and now how do we want to work this path forward with everybody in the room? And I was able to say, here's our options, which was both of their options, to say, here's what we've looked at and considered, and here's what we feel like is the best path forward. And so, again, I was fortunate that I had those outside directors that I was able to confer with and get lined up on the conversation so that we could have that, so we can move forward. The other time, I didn't have that same scenario where I didn't have outside board members. And basically, I just had to go to the managing director of the firm, a partner of the firm, and just say, hey, you need to tell me what you want, and because I'm getting these conflicting stories, and basically ask him to referee, right? And say, what does the investment committee want to do? Because the worst thing you can do is let it flounder, right? I mean, if you think you're going to kick the can down the road, keep both sides happy, you're not going to do it. You've got to bring it to a head. You've got to get everybody understanding what's the pros and cons of either scenario, and then everybody get lined up on that. So again, that's why I always like to have an outside board member if I can have one. Some PE firms don't like to have them, some do. But I find them to be very, very helpful in situations like that if you do have that resource to lean on.
Yeah, I would agree with that. And many in our audience know this, and you three know it all too well. There's not a lot of consistency in board construct. So some sponsors proudly claim we don't use boards. Of course, they themselves are the board if there's only 2 or 3 folks from the sponsor. Others have outside board directors that are undercompensated and sort of there for general perspective or value add. Others do a really nice job of having meaningful outside board directors, and a few funds, not most, but a few of them will even name an outsider as chair. And that gets a lot of high marks from executives, where that person is there to straddle, the realities of management and investors, and wants the best for everybody. But I guess, Bob, what you're saying is, when in doubt, go to the person who's got the most influence, that you trust the most, and ask for their help in refereeing the situation.
Absolutely. Yeah, absolutely. And I think you bring up a great point about outside, chairman or outside director. I call them the translator, right? They're great translators for you, right? Because sometimes as operators, you're talking about something, you want to drive something, and then the PE guys are talking about something, and that outside board member, that impartial third party, if you will, can help translate to make sure you're talking, to each other, not past each other. And that's where that role is so valuable to you as a C team to get things moving if you are in a rough patch, right? Because it usually happens in a rough patch. And the other point that I want to make to you is, when you're usually hearing conflicting stories from your PE guys and gals, is that they have different motivations, right? The reason I was getting the lead director is that, he was trying to protect his money on money return record, right? The other director was like, hey, we're in a tough situation. The macros don't look good. We just need to get out of this thing with some money back on the table. And ultimately, that's where that one got settled, was, right, the managing partner said, hey, we've never lost money on the deal. We've always got our money out plus some, and that's what you need to go do. What the lead guy is telling you, don't try to get 2 times, don't try to get 3 times. You go put us in a position to get our money out so we can have some return to the LPs, and that's your marching orders. And so, always understanding where you're at in the portfolio, in the fund, right? You're one of many bets in the fund. Understanding where you're at, how you're performing, how the other peer portfolio companies are performing will end up dictating what your role is within that portfolio, within that fund. And so understanding your role within the fund is also very important to you. Are you the guy that, everybody wants a 4-on-4 money return or better, but that's not the reality, right? So, do you need to, count on, are you towards the end? Are you one of the last companies to go, one of the first companies to go? All of those things, go into the calculus behind the PE guys' minds around how they're acting. And so you do, understanding that helps you kind of navigate as well.
Yeah, and not just how your peer groups are doing in the portfolio, but what vintage of the fundraise owns that
Absolutely.
company. And if you're in fund 3 and you're the only good company and the rest are dogs, boy, that's an interesting place to be.
Oh.
For sure.
Oh, there's a lot of pressure. There's a lot of pressure there.
So, last question, then we'll save time for a 30-second final thought. So, a couple questions here. What if you find yourself in a deal where the sponsor doesn't seem to have a grasp on the industry? Maybe they're generalist investors and they just don't seem to understand what they bought and they're struggling, or they do maybe know the sector, but they missed on diligence or they overpaid or when you find yourself in a tough situation where you're, below par on your option strike, any quick advice on how to think through whether to fish or cut bait on that situation?
I would say you own that and you're on it. Like, I don't know that I honestly have gone into a business where the PE was like, oh yeah, I totally knew all that. Right. It just, and I've done this a few times. And so what I have found over my various tenures is assess quickly, be honest, and have a plan. So, I firmly believe as an executive, it's our job, if you have that right partnership leadership, right, to assess an underperforming asset and then come up with a plan to change that and to deliver the outcome that frankly we're all aligned to. So I think that's what I would say is, one, they're not going to be shocked. They generally know that they don't know all the things. You have to have the confidence to tell them that, and you have to have the game plan as to, yes, this metric is not going the way we want. Here's where I could use your help to go figure out this. And here's the other 3 things we're going to do. That would be what I feel has worked for me.
Rob, you mentioned, you said transparency. Your study shows transparency. I think to leverage what Heather said, you show, what you've identified, what the situation is. If my best, and I'll speak for me, not for anybody else, but if my best guess and having analyzed something is that you're going to be lucky if you get out with a one-time return, better say it now instead of later so that expectations are there. Because if your sponsor comes back and says, you're nuts, this thing's easily going to be a 4X and here's where you're wrong or whatever, then that you may just find yourself in a position of, to your point, having to cut bait. But usually when you have that transparency, you all sit down and talk it through, understand, own it, like Heather said, figure out if there is a path that's going to work. Not everything's going to work perfectly. It never does. But that transparency will go a long way.
Bob, any quick thoughts?
I guess the one quick thought is, when you identify that and you get to that and you're saying, hey, we all got brought in under this set of circumstances and this set of expectations, I have been successful in the past of saying, hey, we need to reset the option equity, right? We need to lower the strike price, whatever you need to do to get there. But if you pick the right PE firm that are true partners, that appreciate the transparency, understand, again, unless you screwed up, right? Unless the decisions you made and bets you made didn't pan out. But if you're coming in early, doing the things Keith and Heather just described, and saying, hey, here's what I think is fair for, the equity team. I have had guys do that and reprice. So that is a discussion that you can have. But again, it all comes with the precursors of what Heather and Keith have laid out.
Well, what a great discussion. From my perspective, this could have gone on for another couple hours, but let's be respectful of time and wrap up. Want to thank Bob, Heather, and Keith so much for a great conversation. And my big takeaway is that alignment is a two-way street that needs to be actively pushed and influenced by management and not to be on the receiving end of it. And you can do that constructively. You can do that as a good partner. You can lead with transparency and influence and inspire confidence, and you can get to a pretty good outcome. But if you default on those things, your world's going to be cocooned in a way that the PE firm thinks best, and that's never a great thing.
Nailed it, Rob.
There you go.
Okay, awesome. Everybody, thank you so much. Have a great rest of your day. Take care.
Thank you.
Thanks, guys.